If you observe carefully the migratory movements, public debt cycles, and changes in productivity patterns across the United States, you'll see a pattern emerging, a pattern that repeats throughout history, a pattern that, when understood, reveals why certain regions become value traps for real estate investors. This is not a prediction. It's a logical consequence of forces already in motion. Today, we're going to examine 5 American states where investing in real estate in 2026 may represent significant risk to your wealth. Not because I have a crystal ball, but because the economic, demographic, and fiscal fundamentals of these states follow patterns that history has already taught us. If you understand the incentives, you understand the behavior. And when a region's incentives push people, businesses, and capital away, the real estate market inevitably reflects that reality. Let's start with a simple question. Why do some regions thrive while others decline? The answer lies in cycles, debt cycles, competitiveness cycles, human and financial capital migration cycles. History is an excellent teacher when it comes to understanding regional decline. Think about Detroit in the 1,970 seconds. It was the center of America's automotive industry. Middle-class families built fortunes investing in residential and commercial real estate. What could go wrong? What went wrong was that Detroit lost its ability to create competitive value. High operating costs, excessive regulations, and an unsustainable tax base created an environment where it was more rational to produce elsewhere. When the industry moved, high-quality jobs disappeared. When jobs disappeared, people moved away. When people moved away, demand for real estate plummeted. This is a cycle that repeats. It's not specific to Detroit. It's a universal principle. In the 1,980 seconds, we saw similar patterns in parts of Pennsylvania and Ohio. Regions that depended on heavy industries faced structural decline when global competition and regulatory costs made these areas less attractive for business. The same happened with certain areas of Connecticut in the 1,990 seconds, when financial companies began migrating to regions with more favorable cost structures. The lesson is always the same. When a region loses its ability to attract and retain productive capital, real estate values eventually reflect this new reality. Now, in 2026, we're seeing these same patterns emerging in 5 specific states, states that, for different reasons, are losing their magnetic force to attract people and productive businesses. To understand why certain states represent elevated real estate risks, we first need to understand the fundamental principles that determine long-term property values. Real estate is essentially the crystallization of value created by productive people in a given location. When talented and capitalized people move to an area, demand for residential and commercial space increases. When they move away, demand decreases. This isn't opinion, it's mathematics. If you understand the incentives that make people and businesses choose where to live and operate, you understand the forces that shape real estate markets. Local and state governments depend on tax bases to finance services and infrastructure. When these tax bases are eroded by outflows of people and businesses, governments face 2 painful choices: cut services or raise taxes. Both options create vicious cycles. Cutting services makes the region less attractive. Raising taxes accelerates the departure of high-income taxpayers. In a federal system like the United States, states compete with each other for residents and businesses. States that offer better cost-benefit relationships inevitably attract human and financial capital from less competitive states. This competition isn't optional, it's structural. Aging populations consume more government services than they produce in economic activity. Regions with aging demographics face growing fiscal pressures, especially when young professionals migrate to areas with better opportunities. Real estate markets are highly leveraged. Small changes in fundamentals can create large impacts on values. When a region's fundamentals deteriorate, the risk of significant losses in real estate investments increases substantially. These principles aren't abstract theories. They're real forces that operate continuously in all real estate markets. And when we apply these principles to current data, 5 states emerge as particularly problematic for real estate investments in 2026. Imagine a state that has some of the most restrictive housing regulations in the country, state taxes among the highest in the nation, and business operating costs that grow faster than productivity. That state is California. Since 2018, California has experienced a net outflow of residents to other states. We're not talking about low-income people. We're talking about high-income professionals, entrepreneurs, and retirees with significant capital. Companies like Tesla, Oracle, and Hewlett-Packard Enterprise relocated their headquarters to Texas and other states. This isn't coincidence. It's a rational response to economic incentives. What makes this particularly relevant for real estate investments is that California has created a situation where it's extremely difficult to build new housing due to regulations, while simultaneously losing the high-income residents who sustain demand for expensive housing. When supply is rigidly controlled and demand is declining, you have a recipe for deflationary pressure on prices, especially in higher value market segments. New York faces challenges similar to California, but with unique characteristics. New York City lost approximately 500,000 residents during and after the pandemic. Many have not returned. More importantly, many who left were high-income workers in the financial and technology industries. New York State has one of the highest combined tax burdens in the country. For a retiree with significant wealth, the incentives to remain in New York are increasingly weak, especially when states like Florida offer better climate, lower taxes, and comparable infrastructure. The commercial real estate sector in Manhattan has still not fully recovered from remote work effects. When companies need less office space, this reduces demand for commercial real estate, which in turn affects the entire local economy. Illinois presents a particularly concerning fiscal situation. The state has unfunded pension obligations that exceed its ability to pay without dramatic tax increases or severe service cuts. This is an unsustainable situation that forces painful choices. Chicago, specifically, has experienced consistent population outflows. Companies are relocating operations to states with more favorable business environments. When you combine structural fiscal problems with population outflow, especially high-income population, you create an environment where real estate values face long-term downward pressure. Connecticut is an interesting study in how high taxes can create decline cycles. The state is one of the highest concentrations of high net worth individuals in the country, but also some of the highest taxes. This creates an unstable situation where the residents most capable of paying taxes are also most capable of moving to avoid them. Financial and insurance companies, traditionally pillars of Connecticut's economy, have relocated operations to states with lower costs. The result is an eroding tax base and growing fiscal pressure, creating a challenging environment for long-term real estate values. New Jersey faces a unique combination of challenges: high property taxes, restrictive business regulations, and proximity to states with more favorable environments. The proximity to states like Pennsylvania and Delaware, which offer more favorable tax regimes, makes it relatively easy for residents and businesses to relocate while maintaining access to the same markets. When it's easy to obtain location benefits without the costs, migratory pressure tends to increase over time. Now, let's translate these macro patterns into practical implications for someone considering real estate investments. If you're thinking about buying an investment property, a second home, or even relocating your primary residence, these patterns have direct implications. In markets where fundamentals are deteriorating, you face what we can call asymmetric liquidity risk. It's easier to buy than to sell. When you need to sell, especially in declining markets, finding qualified buyers becomes more difficult. Additionally, declining markets tend to have longer selling periods and effectively higher transaction costs. You may need to accept lower prices or wait longer to find buyers. If you're in the 50 to 60 age range and considering where to settle for retirement, these patterns are critical. Buying real estate in markets with deteriorating fundamentals means that a significant portion of your wealth may be tied up in assets with limited appreciation potential or even depreciation. For retirees, liquidity and capital preservation are more important than aggressive growth. Investing in markets with negative demographic and fiscal trends goes against these objectives. If you already own real estate in one of these states, this doesn't necessarily mean you should sell immediately, but it means you should be aware of the risks and consider diversification strategies. It may make sense to consider gradual wealth reallocation to regions with stronger fundamentals, especially if you have geographic flexibility. Even if you invest in real estate through funds, it's important to understand the geographic exposure of these funds. Funds with high concentration in problematic markets may face performance pressures that aren't immediately obvious when looking only at historical financial metrics. It's important to understand that these adjustments don't happen overnight. Real estate markets adjust slowly due to the illiquid nature of the assets. This means you may not see dramatic price impacts immediately, but underlying trends are establishing themselves. In markets where fundamentals are deteriorating, price pressure tends to materialize gradually, then more rapidly. Based on the principles we've discussed and the patterns we've identified, here are practical guidelines for making more informed real estate decisions. Don't concentrate all your real estate wealth in a single region, especially if that region shows signs of deteriorating fundamentals. If you live in one of the problematic states and your primary residence represents a large portion of your wealth, consider how to diversify through investments in other regions. Think of geographic diversification like portfolio diversification. You wouldn't put 80% of your investments in a single stock. The same principle applies to geographic locations. Invest where capital is flowing, not where it's leaving. States like Texas, Florida, Tennessee, and North Carolina have attracted consistent flows of people and businesses. This isn't a guarantee of future performance, but it indicates stronger fundamentals. Observe not just where people are moving, but what type of people. Migration of high-income professionals and businesses is more significant for real estate values than general migration. Evaluate the fiscal health of jurisdictions where you're considering investing. States and cities with unsustainable debt and pension obligations face pressures to raise taxes or cut services. Both are negative for long-term real estate values. Look for jurisdictions with responsible fiscal governance and diversified tax bases. In a world where mobility is increasing, relative competitiveness becomes more important. States that offer better cost-benefit relationships tend to attract capital over time. Consider not just the current situation, but the trajectories. States that are improving their relative competitiveness are more attractive than those losing competitiveness. Regions with young and growing populations generally have better long-term real estate prospects than regions with aging and declining populations. This doesn't mean completely avoiding areas with more mature demographics, but it means being aware that these areas may have different growth dynamics. In markets with deteriorating fundamentals, you need higher expected returns to compensate for elevated risks. If you're considering investments in problematic markets, make sure prices adequately reflect the increased risks. Frequently, gradually declining markets maintain prices that don't fully reflect underlying risks, creating value traps for unwary investors. If you need to sell properties in problematic markets, consider doing so before negative trends accelerate. If you're buying, be especially cautious about timing in markets with deteriorating fundamentals. What looks like an opportunity may be a falling knife. For those who already have significant exposure to these markets, consider protection strategies like hedging through investments in stronger regions or uncorrelated assets. Don't ignore signs of deterioration hoping they'll reverse. Markets can remain unbalanced for longer periods than individual investors can remain solvent. Over decades of observing markets and cycles, I've learned that one of the most valuable lessons is also one of the most humble, recognizing what you don't know. I cannot predict exactly when or how real estate adjustments in these 5 states will manifest. Markets can remain unbalanced longer than seems logically possible, but I can observe patterns. And the patterns we see today are powerful forces that have historically impacted real estate values significantly. The key isn't trying to time these movements perfectly. The key is understanding the forces at play and positioning your wealth so you can prosper regardless of specific timing. If you understand the fundamental principles, you have tools to navigate any real estate environment. Regions that prospered in the past may face challenges in the future. Regions facing challenges today may find ways to reinvent themselves tomorrow. History is full of examples of cities and states that seemed to be in irreversible decline but found ways to transform themselves. Pittsburgh reinvented itself after the decline of the steel industry. Boston reemerged as a technology and education center. But it's also full of examples of regions that failed to adapt and faced decades of decline. In investing, as in life, it's better to be prepared for unfavorable developments that may not happen than unprepared for unfavorable developments that do happen. If you have significant exposure to the real estate markets we've discussed, don't panic, but be prepared. Have contingency plans, diversify when possible, maintain adequate liquidity. Real estate markets operate in long cycles. What seems like a permanent trend today may be a temporary aberration. What seems like a temporary aberration today may be the beginning of a decades-long trend. Wisdom lies in positioning yourself so you can benefit if you're right about trends, but won't be devastated if you're wrong. In the end, investing in real estate, like any investment, isn't about predicting the future. It's about understanding fundamental principles and positioning yourself according to those principles. The principles we've discussed today aren't specific to 2026 or to these 5 states. They're universal principles that apply to any real estate market at any time. Flow of people and capital, fiscal sustainability, relative competitiveness, demographics. These are the pillars upon which long-term real estate values are built or destroyed. If you understand these principles and apply them with discipline, humility, and patience, you'll be much more likely to preserve and expand your wealth over time. It's not a guarantee. There are never guarantees in investing, but it's an approach based on solid principles that have withstood the test of time. And in the end, that may be the only sustainable advantage any of us can have. History is an excellent teacher. Principles are our guides, and humility is our protection. Use these tools wisely.